Today is Monday, June 7th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Steve Freed, President of Grain Research at ADMIS, Alan Bush, ADM Investor Services Senior Financial Economist, and special guest David Hightower, President and founder of the Hightower Report. Dave, let's start this morning with a question about commodities in general. From your perspective, what are the dominating fundamentals in the commodity market for the rest of June and heading into the heart of summer?
Well, we had a shift from 3 days ago, in which the non-farm payroll came out, and it was a miss on the downside. And so, if it would have been at expectations, there would have been a lot of tapering talk in the marketplace, and we'd have a lot of red on the screen now. So we have good data is bad for stocks and commodities, and bad data is good for stocks and commodities. So you have now. We do have inflationary signals propping up all over. We have some inflation readings later this week, but I believe we had a change of sentiment right now. And the Fed, the timing of the tapering has been pushed back. And so what that does is it should allow stocks to continue to go higher, and it might allow for a little bit more inflationary, probably being driven by something else. I'm just saying that adds to it. And the energy markets probably still go up. So, we're down to 11,000 infections a day. The TSA security checkpoint numbers are still 600,000 below a normal year at this time. So we're going to have to see some recovery now, and it's not going as fast as we thought.
Steve, let's look at the grain markets. Grain markets continue to trade higher. Why, and will prices continue to trend higher?
It's pretty much all weather. Yesterday, the European models came out for June, July, and August with continued warm and dry conditions for the upper Midwest, the Northern Plains, and the Pacific Northwest. So I think we're adding weather premium over $16 July beans, $7 July corn, and $7 July wheat. And I think if yesterday they were talking about if we have a repeat of last year's corn yield of 172, we could go and test the 842 highs in 2012. So I think the trend is still higher as long as the weather is less than ideal.
Steve, I know we're behind in precip here in the Midwest. How bad is it? How much behind are we, and how bad is it?
27% of the U.S. Midwest is in drought or severe drought situation. That's mostly up in the upper Midwest and the Northern Plains. 10% of our corn, 15% of our soybeans are planted in those areas. So right now, there are some weather experts who believe that we're slowly getting into some ridge building that could be similar to 2012.
Dave, during your answer a moment ago, you mentioned the oil. What are your thoughts about oil prices, and do you think, or where do you think prices will settle this summer?
Well, again, you tie it back into the economy, and with the OPEC Plus getting ready to raise output this month and then next month, that puts the onus on us to see this stuff needs to be consumed now. So see the world floating storage of crude go down by 47% over the week prior. And if you look at the API report, every single major inventory, gasoline, distillate fuel, and diesel, all those stock levels are significant deficits to year-ago levels. So they did a wonderful job of keeping the oil market balanced. And it's a fight now between this incoming supply and how quickly you're going to ratchet up demand. And I don't know, there's a feeling out there that we're going to have a record gasoline demand reading at some point in the next month. The commitment to traders positioning report does not show either market to be excessively bought out yet. So 75, who knows? For Iran, if they don't get the sanctions off, maybe we'll go to 80 like Goldman Sachs predicts.
Alan, the stock indexes, why did stock index futures advance after Friday's rather weak employment report?
Well, I think David explained it very well that the bad news is the good news, and that has been the case for stock index futures. And basically, it comes down to how the interest rates are affected by the news. And of course, a weak employment number exerts downward pressure on interest rates, and that was supportive to the stock index futures. And we're actually not that far from record highs in some of these, the S&P and the Dow. So there's likely to be follow-through gains. Not today, we're a little bit lower, but I think ultimately we will break out to the upside in stock index futures.
Alan, silver and gold, which one of them do you think will be the leader in that complex?
Well, first of all, I'd like to say I like both the gold and the silver, but I think the gold will probably be the leader to the upside. And you can actually see that on the charts where the gold has outperformed the silver as of late. And I think one reason is that the silver has more of an industrial component than the gold market does. And if I'm correct in thinking that the global economy will recover quite well, but maybe not as strong as some analysts are anticipating, that the silver might lag, but both gold and silver will, I believe, trend higher, and of course, led by the gold market to the upside.
Alan, just one more question for you while I have you here. Um, the US dollar, what's the outlook for the US dollar?
It still looks lower now. Where I can see we're right now. In fact, we've broken the 90 level. The next support is 89.51, and that was a recent low. And then at 89.15 is a low that was made in January. So the fundamentals, in my opinion, still are on balance bearish. So I would look for lower prices, and ultimately, I think both of these supports that I mentioned will be taken out on the downside.
Steve, looking out a few days, on June 10th, there's a grain report. What are your expectations for that grain report on the 10th?
Well, I think first of all, by crop in the wheat, they may raise the U.S. wheat crop number, but on Friday, one private group said that the spring wheat crop could be 65 million bushels below their estimate of 505, and last year was 530. So a lower spring and durum crop could offset the higher winter wheat crop eventually. I don't think they'll make much changes in the bean S&D. They believe that 120 carryout is minimum. But in the corn, they could lower the Brazil corn crop. They could raise corn demand. Some people think that this year's carryout could be as close as 1050, and next year's carryout is close to 1200 versus their 1502. And all of that includes higher acres and a record corn yield. So anything less than that, and I think that USDA is going to have to tighten these carryouts even more.
Finally, Dave, one final question for you. What is your best near-term trade recommendation?
Well, I have several. First of all, I think either the Swiss or the euro, they're recovery. I believe, like Alan, that the dollar is going to weaken. You know, we're going to hold our rates down while the rest of the world's going to raise theirs. So they'll pull even with us, maybe even go higher than us. We're going to find out. We're going to put the Fed under a huge test. Are they going to do what they told us, and that's hold these rates down? And if they do, I think that's going to make the Swiss and the euro have a lot of appreciation on the upside. And also, along that same line of thinking, the Treasury bond market is not really priced for tapering. And when that happens, in fact, they did stop buying corporate bonds. So that's the beginning of this. We have inflation all over, and the bond market might have one of the biggest downside potentials that I've seen in that market for 10 or 15 years. And I'm talking compacted and fast. So you can go out and look out and go out to the D's and buy. I would buy multiple out of money puts because you're trying to get it cheap. You're trying to get it leveraged, and again, it's not the strike; it's how big your delta is. So that, and then one last thing for the producers, for the farmers, the corn market. We have this huge historical bull market going on, and you should be considering doing a hedge. And I would look at that same thing. Go out in March 2022. I would sell a $5 March put, and I would turn around, use that money, and buy 5 of the 420 puts. It'll cost you like a nickel. And again, not the strikes, but how much of a and so if we start to fall over, maybe you'll have a little bit of a leverage hedge on.
Thank you, guys. And a big thanks to you, Dave, for joining us this morning. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.